A call option looks like a bet on the future. So most people think you price it by forecasting where a stock will go. That feels right. It is also the wrong starting point. Black-Scholes-Merton changed the game with one brutal idea. You do not price an option by prediction. You price it by replication. If you can build a portfolio of stock and cash that copies the option's payoff, then the option and the portfolio must have the same price today. If they do not, arbitrage steps in. That is the whole engine, not clairvoyance, not vibes, not a heroic market call, just no arbitrage and a hedge that kills short-run stock risk. Then a famous formula drops out. That line helped turn options from a murky side market into a modern industry. It also became a template for pricing risk across finance, corporate debt, loan guarantees, insurance-like promises, real investment choices. One equation, one hedge, a huge change in how markets think. Imagine a stock at 100. You hold a call option with strike 105. It expires in 3 months. What is that right worth today? Too high, and buyers walk away. Too low, and sellers get picked off. The contract is simple, the price is not. A call only pays if the stock ends above the strike. Its payoff is one-sided. The buyer can only lose the premium paid. The upside can run far past the strike. That asymmetry makes instinct hard to trust. Before listed options, many option contracts traded over the counter. Each deal could have its own terms. Prices were hard to line up. Trading was thin. Clear price quotes were rare. SIBO's own history later described that world as murky before standardization. Joe Sullivan pushed to change it. On April 26, 1973, the Chicago Board Options Exchange opened in a converted smoking lounge. It used CRT screens. It was the first listed options exchange in the world. At the start, only a handful of stocks traded there. That sounds small. It was not small. It changed the market's shape. Standard contracts made prices easier to compare. A central exchange made trading easier to see. More traders brought more liquidity. And 1973 brought a second change. Fisher Black and Myron Scholes published the formula that became the field's landmark. That same year, Robert Merton published a related treatment. He generalized the method. He also derived the result another way. In 1997, the Nobel press release said Merton and Scholes were honored for a new method to determine the value of derivatives. It also stressed Fisher Black's central role. He had died, so he could not receive the prize. Now get to the real problem. The hard part was never writing the payoff at expiry. Anyone could do that. The hard part was deciding what risk deserves what price. Stocks have expected returns. Risky assets usually do. So should an option carry its own special risk premium? That sounds fair. Options are risky. Their prices can swing fast. But Black, Scholes, and Merton found a way around that question. That was the key move. If you can hedge the option with stock in the right amount, then the combined position has no short-run stock risk. A riskless portfolio should earn the risk-free rate. It should not earn some extra premium for option risk. That is the insight the Nobel Committee later singled out. So the puzzle was never just this. Where will the stock go? The deeper question was this: can I build the option out of simpler pieces? Before this framework, traders used rules of thumb. They looked at similar deals, they bargained, they guessed volatility from experience, they leaned on a feel for likely stock moves. Some of those methods had craft in them. None gave a clean general benchmark built on no arbitrage. That gap mattered because options are nonlinear. A small stock move does not change an option by a fixed amount. The sensitivity changes as the stock moves. That means simple linear pricing breaks down. Pricing a call by rough analogy is like pricing car insurance by asking only where you parked today. You miss the shape of the risk. And this mattered far beyond a trading floor. Once you can price one contingent claim by replication, you can attack many others. That is why this idea reached past stock options. The Nobel press release pointed to corporate liabilities, guarantees, insurance, and real options. A firm's equity can look like an option on the firm's assets. A loan guarantee can act like an option. An investment chance can look like a right without an obligation. That widened the blast radius. This was not just a trading formula. It was a way to think about claims, promises, and risk. So by the early 1970s, three needs sat on the table at once. Markets needed standard terms, theory needed a price anchor, practitioners needed a common language. Black-Scholes-Merton helped supply all three. The timing was uncanny. A listed options exchange arrived just as a usable pricing model arrived. One built the venue, the other built the ruler. And once traders had both, the old question changed. The question was no longer only what tomorrow might bring. The question became what a payoff is worth today. There are four main characters in this story. First, Fisher Black. He helped frame the problem with rare clarity. Second, Myron Scholes. He co-wrote the 1973 paper that made the formula famous. Third, Robert Merton. He widened the framework. He also derived the result through continuous time trading logic. Fourth, the market itself. Without a market, a formula is a theorem. With a market, it becomes infrastructure. The 1997 Nobel press release drew the line with care. Black and Scholes published the formula in 1973. Merton generalized it. He also derived it in another way. The shared break was the hedge argument. Not a better crystal ball, a better way to copy a payoff. There was also a quiet supporting cast. Exchange designers made contracts standard. Market makers posted prices. Clearing systems cut fear of default. Later, quants mapped where the model breaks, because it does break. We will get there. But first, the equation itself. Here is the Black-Scholes-Merton price for a European call option. C equals S times N of D1 minus K times E to the minus RT times N of D2. Here, C is today's value of the call option. S is today's stock price. N of D1 is the normal curve area tied to D1. K is the strike price. E to the minus RT is the discount factor that turns the strike into present value. N of D2 is the normal curve area tied to D2. And the two hidden scores are these. D1 equals the quantity ln of S over K plus the quantity R plus sigma squared over 2 times T, all divided by sigma times the square root of T. Here D1 is the first distance to strike score. Ln of S over K is log moneyness. R is the risk-free interest rate. Sigma is the stock's volatility. T is time to expiration. D2 equals D1 minus sigma times the square root of T. Here D2 is the second distance to strike score. D1 is the score we just met. Sigma is the stock's volatility. Square root of T scales that volatility by time. Now the plain English read. The first term, S times N of D1 is the stock side part. The second term, K times E to the minus RT times N of D2 is the present value of paying the strike weighted by the model. Subtract the second from the first, you get the call's value. But do not treat N open close like a black box. N of X is the area under the standard normal curve up to X. Here X is any score on that bell curve. It is a model weight from the bell curve. That is all. No magic, no oracle. Now a subtle point. People often hear that N of D2 is the chance the option ends in the money. Under the model, and under risk-neutral pricing, it is tied to that event. But the safer feel is this. N of D1 and N of D2 are weights built from two distance to strike scores. They are not plain everyday probabilities in the way most people mean that phrase. D1 and D2 tell you how far the stock is from the strike after you adjust for time, volatility, and the model's drift logic. They are standardized scores. Think of them as two model-specific measures of moneyness. One goes with the stock term, one goes with the strike term. If the strike is a finish line, D1 and D2 are two ways to measure the gap. You account for fog, time, and the shape of the road. The Nobel press release summed up the main pushes on price. The option's value rises when S rises. It rises when sigma rises. It rises when R rises. It rises when T rises. It rises when K falls. Most of this feels plain. A higher stock helps a call. A lower strike helps a call. More time helps because good outcomes have longer to show up. More volatility helps because the call buyer can only lose the premium. The upside stays open. The rate effect is less plain. A higher R lowers the present value of paying the strike later. That tends to help a call. More uncertainty can make a write more valuable. That feels backward at first. Then you recall that the downside is capped. Now the heart of it. Options are priced by replication, not prediction. Say the option value is V of S, T. Here V is the option value, S is the stock price, T is time. That means the option depends on stock price and time. Assume a stock follows a continuous random path with volatility sigma. Assume you can trade all the time. Assume no trading costs. Assume you can borrow and lend at rate R. These are strong assumptions. We will break them later. For now, they let us isolate the logic. The option changes for two reasons. Time passes, the stock moves. If you hold one option and short delta shares of stock, you can pick delta, so the portfolio has no first-order exposure to tiny stock moves over a short instant. That is the delta hedge. Here, delta is the number of shares used in the hedge. dV over ds is the option sensitivity to the stock price. dV over dt is the option sensitivity to time. d2v over ds squared is curvature, the gamma-related term in the equation. R is the risk-free interest rate. Sigma is the stock's volatility. Here is the idea without drowning in calculus. Over a tiny moment, the option wiggles with the stock. The stock position wiggles too. Pick the stock amount just right. Those wiggles cancel. What remains is locally riskless. A locally riskless portfolio cannot earn any old return. If it could, traders could print money. So it must earn the risk-free rate. That no arbitrage rule gives the Black-Scholes-Merton partial differential equation. dv over dt plus 1/2 times sigma squared times s squared times d2v over ds squared plus r times s times dv over ds minus r times v equals 0. Here, dv over dt is the option's sensitivity to time. Sigma is the stock's volatility. S is the stock price. d2v over ds squared is the option's curvature with respect to stock price. R is the risk-free interest rate. dv over ds is the option's sensitivity to stock price. V is the option value. That line is the engine room. The closed-form call formula is the polished dashboard. First comes the hedge, then the partial differential equation, then the formula. Why was this such a big deal? Because notice what is missing. There is no separate expected stock return term in the final pricing equation. No special premium for option risk. That was the Nobel-cited insight. Once the hedge strips out the stock risk through dynamic replication, the pricing problem falls to no arbitrage at the risk-free rate. You do not need to know what return investors demand for holding the stock. That shocks people the first time they see it. The market's view of average stock growth drops out of the option price. Not because growth doesn't matter in life, because it doesn't matter to this hedge. Let us say it cleanly. A call option is hard to price straight on, because its payoff is curved. But over a tiny instant, you can neutralize its stock risk by trading stock against it. That makes a portfolio with no short-run uncertainty from the stock's random move. A riskless portfolio must earn the risk-free rate. That gives a differential equation. Solve that equation with the payoff max of s minus k, 0 at expiration. Here, max of s minus k, 0 is the call payoff at maturity. S is the stock price at expiration. K is the strike price. Out comes the call price. The option is worth the cost of continuously reproducing its payoff. It is not the winner of a forecast contest. Now we can see why n of d1 and n of d2 appear. When you solve the equation for a European call under these assumptions, the normal distribution shows up on its own. That happens because the model says the stock's log price follows a diffusion. Under that diffusion, future log prices are normal, so the bell curve is not decoration. It is built into the assumed motion. Ln of s over k measures log moneyness. Here, Ln of s over k is the log of the stock price divided by the strike price. Sigma times square root of t scales uncertainty over time. Here, sigma is volatility. T is time to expiration. The R term handles discounting and the risk-neutral setup. The sigma squared over 2 term comes from the geometry of continuous compounding in the process. You do not need every calculus step to grasp the shape. Distance to strike, scaled by uncertainty, weighted by a bell curve. Discount the strike, subtract, that is the structure. Take a small numeric case. Suppose S equals 100, K equals 100, R equals 5%, sigma equals 20%. Then, Ln of S over K equals 0. Sigma times square root of T equals 0.2. Open parenthesis. R plus sigma squared over 2, close parenthesis, times T equals 0.05 plus 0.02. That equals 0.07. So D1 equals 0.07 divided by 0.2. That is 0.35. D2 equals 0.35 minus 0.2. That is 0.15. N of D1 is about 0.637. N of D2 is about 0.560. E to the minus RT is about 0.951. So the call value is roughly this. C equals 100 times 0.637 minus 100 times 0.951 times 0.560. That gives about 63.7 minus 53.3. C is about 10.4. Do not obsess over the decimals. The point is structural. The stock term is large, the discounted strike term is also large, the option value is the gap between them. Now the wall. Every elegant model has one. Black-Scholes-Merton assumes a lot. Real markets do not fully cooperate. The model assumes constant sigma. It assumes a log normal diffusion for the stock. It assumes no jumps. It assumes continuous trading. It assumes no transaction costs. It assumes frictionless borrowing and lending at rate R. It assumes clean execution of dynamic hedges. That is a useful ideal world. It is not the world. Here is where reality pushes back. Real volatility is not constant. It changes across strikes and maturities. That is why traders speak of smiles and skews. If Black-Scholes-Merton were literally right in every dimension, implied volatility would be flat. It is not. Markets jump, earnings surprise, policy shocks hit, wars start, currencies break. A continuous diffusion misses sudden gaps. Hedging is discrete, not continuous. You rebalance now and then. Between rebalances, the stock can move. Transaction costs matter. Liquidity matters. Margin matters. Funding matters. In crashes, correlations can surge together. That can punish hedges right when you need them most. If a stock gaps down 20% overnight, no continuous hedge can save you. The market was closed while the jump happened. This is the mature view. Black-Scholes-Merton is not the last word. It is the baseline language. Modern volatility surface models respond to where it misses. Local volatility models respond to where it misses. Stochastic volatility models respond to where it misses. Jump models respond to where it misses. In that sense, modern derivatives work maps the model's errors. That is not failure. That is progress. A first model gives you a benchmark. Then the market teaches you where the benchmark bends. There is also a cultural lesson. Sophisticated models do not repeal market stress. The Federal Reserve's history of long-term capital management is the classic warning. On September 23, 1998, 14 banks and brokerage firms put in $3.6 billion to prevent LTCM's collapse. It did not lend its own funds. LTCM had 2 Nobel laureates on the team. It used sophisticated models. It also used heavy leverage. Near the end of 1997, debt was about $30 for each $1 of capital. Then Russia defaulted. Then Russia devalued. Spreads moved the wrong way. In August 1998 alone, LTCM lost 44%. The lesson is not that math is fake. The lesson is that models live inside markets with liquidity shocks, crowding, leverage, and regime breaks. A model can be right in normal times. It can still fail you in a panic. The original puzzle asked for one clean price. The wall says that the clean price is only a benchmark when trading is continuous, liquid, and calm. Black-Scholes-Merton gave finance a disciplined core. It did not give anyone immunity from reality. The formula is not gospel. Inside the regime where it holds, it is the cleanest lever we have. And here's what the market did with it. It helped scale a market. Listed options brought standard terms, clear prices, and deep trading. A pricing rule gave buyers and sellers one point of reference. Those two things turned options trading into an industry. The scale now is huge. Cboe said its 4 options exchanges traded 3.8 billion contracts in 2024. Average daily volume was 14.95 million contracts. It was the 5th record year in a row. SPX options alone traded 784.2 million contracts. VIX options traded 209.2 million. In the 4th quarter of 2024, 0 days to expiry SPX options made up 51% of SPX volume. That is not a side market. It is a core part of modern finance. Black-Scholes-Merton helped turn listed options into a market with a common language. It gave dealers, exchanges, risk managers, and scholars one benchmark to argue around. The formula did not create derivatives on its own, but it helped make them readable, and listed options are only one slice of the derivatives world. The Bank for International Settlements said OTC derivatives notional outstanding reached $846 trillion at the end of June 2025. That was up 16% from a year before. Gross market value was $21.8 trillion. Interest rate derivatives were 79% of OTC notional. Those numbers are not all options, but they show the scale of the world that no-arbitrage pricing helped shape. That is what traders do with Black-Scholes-Merton in practice. They use it as a benchmark. They run the formula backward to get implied volatility. Implied volatility is the volatility number that makes the market price fit the model. They quote vol instead of price. They hedge delta. Delta is the option price change for a small move in the stock. They watch gamma, vega, theta, and rho. Gamma is the rate at which delta changes. Vega is the option price change for a move in implied volatility. Theta is the options change as time passes. Rho is the option price change for a move in interest rates. They compare market prices to model prices. They fit volatility surfaces across strikes and maturities. A strike is the set exercise price in the option. A maturity is the time left until the option expires. They stress test jump risk and liquidity risk. Jump risk is the risk of sharp price moves that do not come in smooth steps. Liquidity risk is the risk that you cannot trade near the price you expect. If you remember one practical thing, remember this. Traders often use Black-Scholes-Merton less as a literal truth machine and more as a common measuring stick. The equation endured for plain reasons. It is compact. It is easy to read. It links straight to hedging. It can be extended. And it teaches a deep habit of mind. When you face a risky payoff, ask a hard question. Can I replicate it? If the answer is yes, the price follows from no arbitrage. No arbitrage means no free lunch from price gaps for the same cash flows. That habit changed finance. The 1973 market needed a ruler for one-sided risk. The model gave it one. The ruler is imperfect, but it is still the first line on the board. Black-Scholes-Merton did not win by predicting the future better. It won by changing the question. What portfolio reproduces the option? Once you ask that, the fog clears. A delta hedge strips out short-run stock risk. A riskless portfolio must earn the risk-free rate. That logic yields the partial differential equation. Solve it, and you get the famous result. C equals S times N of D1 minus K times E to the minus R times T times N of D2. Here, C is the call option price. S is the current stock price. N of D1 is the standard normal cumulative probability at D1. K is the strike price. E to the minus R times T is the discount factor. R is the risk-free interest rate. T is the time to expiration. N of D2 is the standard normal cumulative probability at D2. The formula is famous. The idea is bigger. Options are priced by replication, not prediction. That idea helped turn a murky market into a modern one. It also gave finance a reusable blueprint for valuing contingent claims. A contingent claim is a payoff that depends on what happens later. Even where the model fails, its failures point to what matters next. Skew matters. Jumps matter. Funding matters. Liquidity matters. That is why this equation still matters. Not because it is perfect,